So are investors questioning the cartel's spare capacity? Well, Josh Young, Chief Investment Officer at Bison Interests, joins us now to discuss. Thanks for joining us.
Thanks for having me.
So I wonder, just in terms of what OPEC Plus announced today, it said in its statement that it's advancing this planned boost to production that was supposed to be for September, redistributing it over July and August. So am I right in understanding that this was oil that was already going to come onto the market in September? It's just coming a little earlier.
Yeah, well, I think what they did is they increased their quota. They aren't actually necessarily increasing production by that much.
What do you mean by that?
So OPEC Plus has had a deal for a little over a year now where they've agreed to increase their production by 400,000 barrels a day every month. And so we've been tracking that. And what we noticed early on was that these countries weren't producing as much as they said they would. We did some analysis and realized that they were unlikely to be able to actually meet their quotas fully. And subsequently, now there's enormous cumulative misses relative to what they've agreed to produce.
Right. OK, so they can make a target, but if they don't meet it, that doesn't mean that they're actually increasing production. We were showing one of the graphs that you supplied to us there. We're bringing it up again just to show that's the production miss in millions of barrels per day that has been occurring. So coming in below OPEC's target.
Yeah, that's right. And obviously a big part of that miss recently has been Russia. And there's a lot of confusion around exactly how much oil is or isn't coming out from Russia. But that was to the best of our understanding and relying on several different generally correct information providers.
So why not change the way that they increase the quota or the target? Why not favor some countries over others that have the capacity to increase production?
So this is one way to actually do that. So by increasing the quota, they give Saudi Arabia and UAE, two of the last countries with likely spare capacity, the ability to produce a little more and remain in the context of their agreement. I think they still remember how painful it was to get into a price war in early 2020, where the result of that was actually oil going negative. And so I think they want to have a good framework. And the reality is that these countries are all running out of spare capacity, including Saudi Arabia and UAE. And as they come to the end of this agreement by the end of this year, it seems likely that they'll have the full amount of production that they're capable of producing, at least currently, online.
There was some discussion that Russia would be exempt from this increase. They didn't go there. What did you make of that decision?
Yeah, I mean, I don't know it's that relevant. I think Russia is producing and exporting all the oil that they're able to. And at the same time, many different Russian oil executives, like I think the CEO from Lukoil said this recently, they've publicly debated potentially cutting a portion of their production, potentially to just get higher prices. So it does seem like Russia is producing what they can, exporting what they can. And it seems like it's very likely that they just don't have what they say they have. And that means that oil prices probably need to be a lot higher.
And what do you think could come out of U.S. President Joe Biden potentially visiting Saudi Arabia this month? If that happens, what do you think could come out of that?
Yeah, I think Biden and other world leaders have been operating under a set of misconceptions around the energy industry and how these things actually work versus kind of what they hope and expect. And so I think there's this understanding that's incorrect that Saudi Arabia is withholding a lot of oil they could be producing and exporting. And the reality is that they actually don't have that much capacity left. And to the extent that they did accelerate their production today, that might come at the cost of reduced ability to produce and as much as they're hoping to tomorrow.
And Josh, I mean, energy companies have been, a rare source of strength for investors this year so far, especially. I wonder where you might see opportunity still.
Yeah, sure. So we've talked about a number of different names here on BNN. I'll share a quick update on a couple that I still think are very compelling, and then one new one that I haven't talked about before.
Great.
So Journey Energy, which I own a lot of and it's done very well, they keep buying additional assets and they're growing their power generation portfolio. And, it's just up and to the right, and they keep growing their cash flow, and they have a lot of exposure to oil and natural gas, both of which have done really well. And so I think that sort of business model is well situated for the current environment because they don't have hedges and because they're able to take this extra cash flow that they're generating and buy additional assets and develop. Their assets are very underdeveloped, and so they still have this great runway. And even though the stock is up a lot, there's a lot more upside there. Similar for Baytex, where they're drilling the best wells in North America and the Clearwater. They're not necessarily the biggest, but on the amount of money it costs to drill, complete, equip, and tie in one of their Clearwater wells, they're competitive with the very, very best wells in Southeast New Mexico and West Texas. So Baytex is very well situated. They keep beating their numbers. It looks likely they're going to beat the guidance that they just put out. And, for that size company to accomplish that sort of beat and raise, there is the potential for them to re-rate up significantly. And then a name that I haven't talked about that's a much more recent position for Bison is a company called Blackstone Minerals. And so not to be confused with Blackstone, the big private equity fund in New York. It's a mineral acquisition and holding company that owns the rights to oil and gas royalties primarily, as well as some non-operated working interests. It pays an almost 10% distribution. So it's like a dividend, except there are some tax implications that are worth considering. And it makes sense for people to consult tax advisors to the extent this is of interest to them. And they're in the core of the Haynesville, which is a rapidly growing gas area where
and
the
I think we have a
drilling rig
chart
count
of
is
yours
increased.
on that too, just to illustrate that. Yeah.
Oh, great. Yeah, sorry. I think there might have been a delay there. So it's really interesting because the rig count is increased, which is great for companies like Blackstone, where they don't have to spend the money for the rigs. So even though rig rates are rising a lot and other service costs are up a lot, they're able to benefit from these incremental wells getting drilled, and production hasn't grown yet, so I think people are just not counting on it, but it's very likely, especially given where those rigs are located and how disproportionately those rigs are focused on Blackstone's land. It seems likely that they're going to actually beat their guidance after having missed in Q1, and that they're sort of sitting at the center of this one remaining U.S. gas play that has takeaway capacity. And so as that production starts to go up and to the right after having been pretty flat for a while, as the extra rigs that are operating translate to extra wells getting completed and then extra gas coming on, Blackstone's a big beneficiary. And then if you look at where gas producers and oil producers have traded, Blackstone has lagged its peers materially, and it just kind of doesn't make sense. I mean, at this sort of dividend or distribution, and with how much coverage they have and how much likely growth they have, being at the core of a gas play in the middle of an energy crisis, and it's been a pretty exciting thing to put on in the portfolio.